In PNC's Young Yu Ma and Carson Group's Ryan Detrick, Scott Chronert from Citi continues with us as well. I'm sure you guys listened into our conversation with all of us together, but I want to start maybe, Young Yu, with you. The idea that the NVIDIA trade has been one of the primary drivers, if not the primary driver, of this last leg higher in the bull market for the S&P and the NASDAQ is something that maybe some skeptics say doesn't really have the legs to continue in the way that it has over the past 3 to 5 years. What exactly do those mega cap tech stocks need to do to keep this thing going?
Well, I do think the market is looking for proof. I think that the market is concerned probably about a pullback in the AI infrastructure spending. And I think that that's something that's probably overblown in terms of the concern about the ripple effects here. But I think what the market wants to see is just proof, ongoing proof that AI can continue to proliferate and produce gains in the economy for companies, for individuals, increasing productivity and increasing efficiency. And I think this is the year where the market wants to see tangible proof. That's what it's looking for. And I think we're on tap to deliver that. But that's what the market is, I think, on pause a little bit until we can deliver more of that.
The show me kind of situation is developing for sure. So, Ryan, if you look at the charts right now, there has been maybe a bit of consolidation, a bit of flagging momentum, but it hasn't been very much. We're still right at or near record highs, even with the modest move lower in today's session. If that is the case, what exactly is leadership going to be, in your mind, for that 2026 trade? Will it continue to be those Mag 7 Elite 8 stocks?
Well, Dom, thanks for having me back. Good afternoon, everybody, and happy holidays. You think real quickly, just today is December 26th. All right, no day, Dom, historically is more likely to be higher, up 81% of the time. So we'll see. Maybe we can get a little rally here. But I love the discussion you had right before I came on. Yes, Carson Group, we've been quite bullish for a while now. We do think that broadening out theme into next year makes a lot of sense. We're more equal weight, large cap tech, but we think the leadership is going to be from those cyclical areas, right? Your industrials, your financials. I mean, materials, they're such a small part of the market, but boy, materials have been on fire. We think those areas is we do not have a recession next year. We have a Fed that's cutting. We have an employment backdrop that isn't that great now. We know that, but probably gets better. All in all, those cyclical areas, we think this bull market is alive and well, and they're probably going to lead us in 2026.
Scott, if I could go back to you for a moment here. We addressed a little bit about some of those corporate profit, perhaps variables and maybe tailwinds, I guess, in some way that will propel the market higher. If we could look back at the macro picture as well, one of the things that will be a key focus for investors all of next year will be the Fed, not just because of leadership changes that are afoot, but also because of what the perceived interest rate path will be. How exactly does an equity strategist start to put those types of variables into your models? And what kind of a role do those things play in ultimately what you forecast to be a year-end target for the S&P 500?
Yeah, well, I'd say the first thing we do is that we look at the rate backdrop. And obviously, we'd prefer to see 10-year yields coming down more so than Fed funds. What that does, it feeds into what we call our fair value model, which allows for earnings growth and other interest rate influences on how we think about the valuation backdrop for the S&P. And that's how we can get comfortable that we can look ahead to this year and expect that a current valuation paradigm, this 22, 23 times forward, 24, 25 times trailing, can persist through next year. So we need that in terms of that Fed trajectory as a starting point. Obviously, we'd like to see inflation continue to come in, which I think it will. We're pretty comfortable with that. But what we do think we're going to be facing here as we go into next year is this ongoing, let's call it push and pull between the productivity gains that we expect to be coming from the AI influence. At the same time, we've got this labor condition that's going to be a source of anxiety, I think, for many investors. So I think the face-off between these is going to be really important, but also behind the scenes, we expect that we, at some level, have an economic sensitive tailwind to the earlier point that comes from a lot of the tax reform measures that were put in last summer. So we think we may end up seeing a little bit of an upside bias to currently expected GDP trends, all of which does support this broadening out into the more cyclical or economic sensitive parts of the market.